So you probably saw the Bloomberg headline screaming that the Fed is considering rate hikes. Your portfolio has recently dropped, you're wondering if it will drop more, and you're considering if you should sell everything. Well, remember, news headlines are designed to scare you. Let me show you what the Fed minutes actually say and why this matters for your money. Look, if you're short on time or you don't want to listen to some random guy on the internet for the next 10 minutes, the Fed is not hiking rates tomorrow. What they're doing is much more subtle and honestly more dangerous for your portfolio. They're reopening what's called a two-sided reaction function, which basically means they're keeping the option to hike on the table while everyone in the market is pricing in 2 to 3 rate cuts this year. That mismatch is what's going to create volatility, and it's going to hit your growth stocks and AI positions the hardest. Now, if you've got a few more minutes, I'm going to walk you through exactly what's in those Fed minutes, what could actually trigger a hike, and what you should be watching to stay ahead of this mess. Alright, so, hey, I'm DataCat. If this is your first time here, welcome. A bit about me. I spent years grinding it out as an analyst inside a Fortune 50 company, the classic corporate slave life. And eventually I realized I'd rather be doing this, breaking down markets and Fed policy from my home office with a mechanical keyboard and a laser pointer for my actual cat. Not the best career choice here, when you consider the fact that your cat doesn't actually love you that much. I started this channel about 7 months ago because honestly, I got tired of watching retail investors get confused by the same financial media headlines that Wall Street traders laugh at. I'm an introvert, I'm not great at hyping things up, but what I can do is read through pages of Fed minutes so you don't have to, and then explain what it actually means for your portfolio. If that sounds useful, hit the like button and subscribe. I don't sell courses, I don't have a premium Discord, I just make these videos and hope for the best that my cat and I won't end up homeless. Alright, let's get into it. So just now, the Fed released the minutes from their last meeting, and Bloomberg's headline was dramatic. Fed reveals surprise shift as several officials ponder hike. And if you just read that headline, you'd think, oh no, the Fed's about to jack up rates and crash the market. But here's the thing, and this is why you can't just read headlines. If you actually go through the minutes, a rate hike is not the base case. It's not what they're planning to do. What the Fed is doing is protecting optionality. They're basically saying, look, we're holding rates steady right now, but if inflation stays sticky, we're not ruling out the possibility of raising rates again. Now, why does this matter? Because the market had priced in 2 to 3 rate cuts this year. That means investors were betting that borrowing costs would go down, corporate profits would stay strong, and stock valuations could stay elevated. When the Fed comes out and says, actually we might hike instead of cut, that forces the entire market to reprice. And that repricing, that's what hurts. If you are new to the market, let me explain the mechanics here, because this is essential to help us understand what's happening before we move on. When you own a stock, you're basically buying a stream of future cash flows. To figure out what that stock is worth today, you discount those future cash flows back to the present using something called a discount rate. The discount rate is heavily influenced by interest rates. So, when interest rates go up, or simply in this case, when the market thinks they might go up, that discount rate rises and the present value of those future cash flows drops. Your stock is worth less. But it's not just about the math, it's also about risk. When the Fed starts talking about hikes after the market expected cuts, it introduces uncertainty. Are they going to make a policy mistake? Is the economy going to slow down more than expected? That uncertainty increases what's called the equity risk premium, which is the extra return investors demand for holding stocks instead of safe bonds. Higher risk premium means lower stock prices. So even if the Fed doesn't actually hike, just the credible threat of a hike can compress valuations, spike volatility, widen credit spreads, and tighten financial conditions. It's like a cat swatting at a glass of water on the edge of a table. The glass hasn't fallen yet, but everyone's watching to see if it will. Alright, let's go through the 3 key sections of the minutes. First, policy stance. The Fed is holding rates at 3.5% to 3.75%. Almost everyone on the committee supported this decision. 2 members dissented because they wanted a cut, but several participants, and this is the important part, wanted language in the statement that would acknowledge the Fed could raise rates if inflation stays above their 2% target. This isn't a hike decision. It's the Fed saying we're near neutral, we're not on a preset course to ease, and if inflation doesn't cooperate, we'll do what we need to do. That's the two-sided reaction function I mentioned earlier. Second, back to inflation talk. Again, as anticipated, the Fed says inflation remains somewhat elevated. They're seeing core goods prices boosted by tariffs, while core services, especially housing, are actually coming down. The concern is whether inflation becomes persistent. Right now, the Fed thinks a lot of the elevated readings are due to tariffs, which could be a one-time thing. But if those tariff costs start feeding into wages and prices more broadly, that's when they get nervous. Think of it this way. If your landlord raises rent because their costs went up due to tariffs, that's annoying, but it's a one-time adjustment. But if your landlord raises rent, then your employer raises your wages to compensate. Then businesses raise prices because wages are up. Then your landlord raises rent again. That's a feedback loop. That's persistent inflation. And that's what the Fed is worried about. Third, about our current financial conditions. The Fed staff noted that financial vulnerabilities are notable, with elevated asset valuations and low credit spreads. They specifically called out AI sector concentration and high valuations, as well as opaque private markets. In simple terms, the Fed agrees that the stock market is expensive, everyone's piling into AI stocks, and credit is too easy. If the market stays this frothy while inflation is still elevated, the Fed might feel like they can't ease because conditions are already too loose. In fact, if stocks keep rallying and spreads keep tightening, the Fed might even feel pressure to tighten, because from their perspective, the market is doing the easing for them. Okay, so the Fed is keeping hikes on the table, but what would actually push them to pull the trigger? Based on the minutes and the current setup, I think there are four main scenarios. The first scenario, the most straightforward one, where inflation persistence becomes broad-based. This is the classic hike trigger. If core inflation stops improving and starts spreading beyond tariff-impacted goods, if services inflation stays sticky, if wage growth picks back up, if companies start reporting widespread pricing power. By the way, the minutes have already mentioned contacts planning price increases. The Fed can't ignore that. They can look through a one-time tariff shock, but they cannot look through a renewed inflation regime. If inflation starts running at 3% consistently and shows no sign of coming back down, hikes become very likely. Then, we have scenario 2, where inflation expectations become unanchored. Remember that the Fed cares a lot about credibility. If longer-term inflation expectations start drifting up, if surveys show people expect 3% inflation instead of 2%, if market-based measures rise meaningfully, the Fed will act to defend their target. This is especially true with leadership changes on the horizon. Committees sometimes overprove their inflation resolve when there's uncertainty about future leadership. Think of it as the Fed being extra cautious because they don't want to hand off an inflation problem to the next chair. Scenario 3, an energy or geopolitical shock. Now, I'm not good at politics, but let's say there's a conflict, or I should just put it, a war with Iran and oil prices spike. That's not automatically a hike, because the Fed usually looks through pure supply shocks if growth is weak. But if oil goes up, inflation stays elevated, and the economy is still described as expanding at a solid pace, which is the language in the current minutes, then the Fed might feel they have to tighten to prevent inflation from spreading into wages and expectations. It's not just about oil going up. It's about oil going up and staying up long enough to contaminate the rest of the inflation picture. And the last scenario where the financial conditions ease too much. This is the sneaky one. If stocks rally hard, credit spreads compress further, risk appetite surges, and consumption stays strong thanks to wealth effects, the Fed might look at that and say the market is doing our easing for us. Conditions are too loose, we need to tighten. It sounds counterintuitive, but remember the Fed's goal is 2% inflation, not higher stock prices. If the market is making their job harder, they'll act. Alright, so what does this mean for you? Let's map out the scenarios. Base case, the Fed holds, then gradually eases if disinflation resumes. This is still the most likely outcome based on the minutes. For equities, this is supportive to mixed. Upside is constrained by high valuations and the fact that the Fed is explicitly saying they're not on a preset course. The biggest risk in this scenario is a choppy, headline-sensitive market. Hawkish repricing case. The Fed keeps talking about hikes even if they don't actually hike. This forces the market to reprice the probability of higher rates. Equities see multiple compression, volatility spikes, and a higher risk premium. In this scenario, growth stocks and AI get hit harder than the broader index. Defensives hold up relatively better. You know, like a cat that knocks over your coffee but then walks away like nothing happened. True hike case. Inflation proves persistent, expectations start drifting, and the economy stays resilient. The Fed actually hikes. This is broad risk off. Credit spreads widen, downside can be material, and the worst hit are crowded long-duration names and high-leverage companies. This is the scenario where portfolios get hurt badly. Stagflation-ish shock. Energy spikes, growth slows. Equities are typically negative, dispersion is high, and the Fed faces a tough trade-off. Do they tighten into a slowdown to fight inflation, or do they ease and risk expectations drifting? Persistent volatility, ugly outcomes. Not fun for anyone, including the Fed. So you might be yelling at the screen now, how do we actually know if we're sliding from the base case into one of the scariest scenarios? Well, here's your checklist. 1. Core inflation breadth. Is stickiness spreading beyond tariff-impacted goods? Watch services x housing, not just headline numbers. 2. Inflation expectations. Not just near-term but longer-term measures. Both market-based and survey-based. 3. Labor market. Is it retightening? Watch wage growth, hours worked, and quit rates, not just the unemployment rate. 4. Financial conditions. Are equities rallying, spreads compressing, mortgage rates falling, the dollar weakening? If conditions are easing while inflation is elevated, that's a red flag for the Fed. 5. Energy and geopolitical risk. Oil prices pass through into core inflation and whether energy costs start contaminating expectations. 6. Fed communications. Are they using explicit two-sided language? Are dissents increasing? Is near neutral shifting back toward restrictive? So, bottom line, the Fed didn't announce a hike yesterday, but they did signal that hikes are back on the table if inflation doesn't cooperate. That's a meaningful shift when the market was pricing in multiple cuts. The most likely path to an actual hike is inflation persistence becoming broad-based, potentially amplified by an energy shock, while growth stays resilient. And even if they don't hike, just the threat of it is enough to compress valuations and spike volatility, especially in long-duration growth and AI stocks. If your position like the market is going to ease conditions, you need to reassess. Watch the data points I mentioned. Stay flexible. And remember, the Fed doesn't care about your portfolio, nor does a random guy or his cat on the internet who claims to care. Do your own due diligence. That's it for today. If you found this useful, hit the like button, subscribe if you haven't already. Alright, DataCat out, and I'll see you in the next one.